Guys, we need to talk about the recession. Want it or not, we will face it. 2023, here we go. The majority of top managers say it, governments say it, and even financial indicators say it. The question is, will you join the camp of those who are afraid and are losing the best opportunities of the decade, or you will get along with winners who turned a recession into a money fest? If you want to join the latter camp, but you just don't know how to act, this video will help you out. First, let's give a quite simple answer to what recession is. It is a significant, pervasive and persistent decline in economic activity. Basically, all the markets are falling down. Usually, recessions are working hand in hand with a significant rise in unemployment, a drop in wages, and a loss in consumer confidence. All types of assets, stocks, food, energy, services, etc., are losing their value, and this goes on for a few years. So, if the economy slows down, people's earnings are under pressure too. And if you earn less, you spend less. It causes companies to scale back on their expenses against low demand. The shortest way to cut some expenses: fire employees. Right now, Google is overwhelmed with headlines pointing at mass layoffs in companies worldwide. Bank of America gave an unpleasant prediction for 2023. The US economy will soon start losing 175,000 jobs per month. This may sound shocking, but that's the reality we've faced many times before, and this time is no exception. But if everyone around is losing, how can you win? You need to focus on the right things and act at the right time. JP Morgan analysts believe that we have another 20% to go from current levels, and it's where we should look at historic data. Stocks should always be your first choice for investment. To date, the S&P 500, Dow Jones and Nasdaq are all dipped significantly, around 20 to 30%, which means the worst is already behind. But there is some space left for a further decline. Since 1946, the average bear market drop was close to 30%, with the most severe one in 2009, when the S&P 500 fell 57%. An average recession drop is around 35%, and we are not that far from that mark. Of course, if something didn't happen before, it could happen in future, but statistics is all we can rely on. Mass capitulation among investors will be the harbinger of the bottom. Usually, that's a time for recovery and things begin to bounce back. But we are not there yet. Real estate is yet another segment you should watch for. Housing declines on a national level are actually incredibly rare. As a rule, the decline never exceeds 10%. According to Wall Street, this time won't be different, as national housing prices are going to decline 7%, with a worst-case decline of 10 to 15%, should interest rates continue to increase. The number of deals with real estate may increase pretty soon, and some good opportunities will appear around. Don't fall for misleading that cash growth is being eaten by inflation. It's pretty fair, but not always. When every other asset is falling in price, sometimes cash could be the only safe haven. In 2018, cash was the best performing asset, by the way. Don't ignore that fact. Those people who have been saving their money in high-yield savings far outpace the market. Here are 5 points that prove you should not ignore opportunities during the recession of 2023. We all should consider this recession a rare opportunity. A wise person recognizes it as a chance to buy top-flight companies for a 30% discount, which is crazy. At the same time, those in doubt will choose a skip and regret scenario. A falling market could and must work to your advantage. There is less competition. In hard times, companies play it safe, but this opens the door for smaller and more aggressive companies to stand out. For example, one study across 16,000 companies found that those who didn't stop advertising got positive growth years after the recession ended. Of course, you still need to overcome the worst. There are way more opportunities. Recessions wipe out the weak from the market. The economy has a way of repeatedly clearing out and bankrupting the companies. Even well-established ones may no longer be able to sustain themselves, thus giving opportunities for newer and smaller businesses to continue developing. After every bear market comes a bull market. As Yahoo Finance points out, historically the S&P 500 has fallen an average of 29% around the recession. Once stocks have found their low, their average return the following year is 40%, and within 2 years the market has increased an average of 58%. Investing at the bottom is much more profitable than pulling out of the market and waiting. The market is always recovering. Act before anyone else knows about it. The truth is, recessions are never confirmed until much later. The Great Recession that began in December of 2007 was not officially announced until December 2008, only a few months before it officially ended. So the time to act is coming pretty soon. Now, having said that, let's take a look into your pocket. Because even though a recession brings various opportunities, it doesn't matter if you got beaten by it instantly. So here's a plan in 5 steps on how to stay in the race. Scale back on your expenses. Track your market expenses and cut back on unnecessary spending while you continue reinvesting as much as possible back into the market. Come up with a plan on what would you do if your income were to drop 20 to 50%. Think through whether you could take preventative measures ahead of time to protect yourself from that happening. Don't forget about cash. Hold some money out of investments. This allows you to feel much safer and act instantly whenever a solid opportunity appears. Around 20% of your portfolio in cash would be nice. Protect your career. Your worst-case scenario is not the market going down. Instead, it's the market going down at the same time that you lose your job. This causes many people to sell off their investments at the bottom before they have time to recover. Try to improve your skills and double down on whatever you're currently doing to hedge incoming risks. Play long. Choose long-term investments as the basis of your portfolio. Most assets recover over time and give substantial profits. So the thing you can do now is to stay in the market and continue buying those assets for 2 to 3 years ahead. Diversify your investments. If you can't personally handle a 20% drop without panicking, maybe you invested too aggressively. If you're completely in US tech stocks, then it's probably a good idea to add large caps and international stocks to the mix too. You can invest in real estate or buy REITs to make your portfolio a little bit more stable. The more legs your portfolio has to stand on, the less likely it's going to collapse. Try to look at different sectors and never put all your eggs in one basket. As you can see, a recession is not so terrible if you understand how to act. Falling markets are all opportunities for investors because markets tend to recover and become stronger. Of course, not all companies will survive a recession, so the right decision is to invest in the top ones, like Google, as well as major indices. Don't forget about asset analysis and don't invest money you can't afford to lose.